How you doing?
Hello.
Okay, we should be up right now. Well, welcome everybody to another episode of the Quantium Research live stream. We're back. We haven't released one of these in a while, but we've been working on a lot of content. In the meantime, everybody's been talking about value stocks versus growth stocks. Probably get rid of these and pull up a couple examples. AMD, classic growth stock. Past couple of days, nice little bounce, but as of recent, they've been a fair bit off their highs. We could talk about so many different names. None of them are in this list, but we'll probably do that if we see there are a couple of peeps coming on down. Let me extend this real quick. Apologies if there are a lot of things around here. Hope everything can be seen. Look at that. Beautiful. Well, so to probably update those who've been following us for a while, I've been a little bit busy just with a couple of other things. We've been launching the new element of the site, the reports, and now we have a team of writers, group of amazing people writing some beautiful content. It's just wonderful to see. It makes you smile every time there's a new piece released. But on the side, I'm also writing just a report on something that I wanted to do, a couple of notes. JD Sports, so in the meantime I might have something about that pop up. But I hope everyone is doing well. Let me put this up. I don't really know if this is a good time to be live streaming because it is, 1 a.m. my time? But this is normally when I like to work most efficiently. A night owl. Let's put up and see. I just got some music in the back, but let's get rid of that. I thought, because I can't play it here, I'll get the little earphones and see how we can go from there. I've been using an app called Clubhouse, if anybody's familiar with that. So I've been involved in a lot of rooms there. That's why it's just been difficult to get some time to stream. The work required, and the platform sometimes bugs a bit. I love TradingView, I love this idea, it's just, it needs to kind of properly be pushed, otherwise it may be something left behind in terms of the community. AMD trying here, really needs to get back above 85 and more clearly, what are we talking, 90 to be back in a breakout. But at the moment it's kind of get hit and then try and recover a bit and continue. If it falls sub 78, prolongs below there, then this is a total breakdown. We're talking about filling each gap. This one, which is this way, around, actually the exact figure for the gap is the closing, 67.61. We've got here 59, 57. So if you believe that breakdown is going to happen, AMD has some nice lower levels to easily capitalize on. One gap, two gaps, and each one would be quite a easy target. Let's see. So yeah, I was looking at JD Sports. I just thought I'd pop on, give some thoughts about growth stocks real quick. The looks from what I've been seeing myself is that growth stocks are performing relatively weaker with respect to value stocks. Now, what are growth stocks? Let's think of examples. A growth stock is a company generally that has high levels of revenue growth, like explosive revenue growth, 100%, maybe even 50%, something like that year on year for a business that's worth quite a lot, let's say billions or whatever. Now, a value stock is generally what we call cyclicals. Businesses that are generally quite old school, they don't have huge growth, they probably pay a dividend sometimes. Those kind of ones where their revenues are relatively constant as long as they grow by a little bit over inflation, which is the rate of price increases across just the average expenditure. So let's say inflation increases by 2%, generally the cost of living is at least 2% higher. So those value stocks generally want to just increase their revenue by that. So they don't end up delivering much returns unless their company's going through transformational periods as if one company like Kraft Heinz, for example, was battered so many scandals and all that, and now all of a sudden people think it can't really get any worse. That's why the shares rallied a fair bit. It's not more so macroeconomic strength or anything being priced in. But those value stocks, it even goes as far as businesses that just weren't doing so well before, retail companies, stores, anything from department stores to cinemas to restaurants, they seem to be doing quite well. And the one thing that stands out is financials. You've seen stocks like JP Morgan, which you wouldn't expect in such a low interest rate environment across most of the developed world. Why is JP Morgan making all-time highs? Look at that. Previous all-time highs, January 2020, pre-COVID, literally a month or so. This is COVID basically hitting it. Let's say 141.1 were the highs, went all the way down to about 76, 77, and it's doubled from those lows. So in an environment where interest rates are super low, you'd think banks, traditional banks, even investment banks, they make money from lending, right? Well, investment banks don't really lend. What they do is they're involved in larger size, lower volume corporate financial activity. And in doing so, these companies have made quite a bit of money. It's probably because the markets have done well despite all this COVID stuff. The real economy is struggling. So traditional businesses that have seen their shares increase in value, retail businesses, restaurants, all that, they have seen their shares do well as well across the board generally. But those companies might not be able to survive because whilst they've had to fire people or just struggle without having any revenues coming in to support themselves, these banks are actually making a fair bit of money and they're doing better than expected. That's why they're in all-time highs. Now, why is it the value stocks right now are doing much better? I could show you just a whole chart of multiple different growth value. I could show you ETS, which would probably be easier, but I just want to show for the sake of it, right? If I switch to something like Baba, completely different markets, but same period, fell off by a fair bit. This is not how I would suggest analyzing anything, but look, whilst the banks have done well, and one example, a tech company in China, a banking company in the US, which isn't a great method to compare, but it's just kind of a point where it's interesting how this move has happened, and on Baba, it's kind of the opposite. It's from the top left to the top right. Now, tech stocks, though, haven't been beaten up. You've seen them take hits, recover a little bit. I think S-Wave is probably a good example to show this whole situation. They were in an aggressive uptrend, 140 or so. I think we got out of the 130s, but I don't think that wasn't on the 10K portfolio, but it was interesting how it went all the way down here, broke the trend, and then reversed aggressively. What are we talking? 2 days straight from 90 to 110. That's 20%, just like that. Three sessions, rather. Absolutely crazy. The whole scene is something that is observed right now. Stocks generally are doing better as a whole. In fact, across international equity markets, I believe a week or so ago, almost every major one you could come across, and also most of the emerging market set, were making 52-week highs. What does that mean? It doesn't look like there's going to be a recession. People come out and say, don't you think stocks are too expensive? We just had a recession. We just had the mother of all stimulus. When that stimulus slows down, yeah, some form of correction, but not like a full-blown recession. We had most businesses across the world having zero revenue, and yet markets didn't really fall by more than 20 or so percent. They fell very quickly because there was a lot of fear, but governments responded accordingly. And so I can't really put my money on the fact that there's going to be some form of recession again. In fact, I think there might be an aggressive bull market, and I'm positioning myself accordingly. I don't have any shorts open at the moment, which is surprising considering there are so many businesses that I think are worthless, including, where are they? They're not on this list. Cineworld. We've talked about them so much in the past. We traded them successfully. I closed my short literally in the tens. It was around, I think, 18 pence or so. That was on this day, yeah, the day where they said, ooh, we don't know if we're going to survive, we're closing everything, people just panic. And I'd been holding for a fair long amount of time. But here, look, shares are now over 5x where they were when I closed my short. Why didn't I go long? Well, I think the company's worthless. Why didn't I go short like over the past couple of days, or why don't I go short? Because who knows where this stock could go. It could suspend any day, but it could also double on some form of rumors where people say it's going to get taken over or any of that stuff, which it wouldn't. But that's when existing shareholders or people trying to trade here try and dump, which is market manipulation in my opinion. But it means if you're short, you get blown up before you end up seeing your money. I'm not willing to hold short on a company that could do, 80%. And then I'd be right. I just don't see that appropriate. Even if it does do that kind of thing. We've seen with GameStop and the likes that stocks don't just move in a way where it's within defined ranges. Sometimes things can get crazy, and when they do, you wouldn't like to be on the other end of that trade when it's breaking out like crazy and you're short, or you're long and a whole primary trend comes to an end. So my kind of strategy moving forward, we haven't really done any trades on the 10K portfolio, but I've been trying to figure out my own a long-term portfolio and other investment accounts. But I think we'll be more active over the next couple of weeks, couple of months. It's a shame. I just have had way too many commitments elsewhere at the moment, and we've been working on our site product, which is beautiful, absolutely beautiful. It's all out now, quantumresearch.co.uk. We've got a lot of articles, anything from US stocks to UK stocks to cryptocurrencies to foreign exchange, anything really. We love everything and anything to do with the financial markets. So if you got the chance to check it out, check it out. Maybe if you like what we do, check out our QR Plus package. But if you don't worry about that. We still got free content as well, because not everybody can put money aside for reports and stuff. And also, some people prefer not to involve themselves with other people's views on things. That's really up to them. But I am aggressively trying to get myself long across the board. One company that I'm a little bit confused about is Ferexpo. Fundamentally, it's great, but I just don't feel that comfortable at this point. But everything seems like it's going to break out again, so we might find ourselves just buying these guys for a little allocation. Beautiful company. JKS is nothing special. Baba, as I've said before, I tried to get a bite here, it didn't work unfortunately, but it could just simply be a continuation lower, in line with my thesis where I think growth stocks are going to underperform. Growth stocks are going to underperform these value stocks that we talked about, the cyclicals. Alibaba is an example of one. I believe that they are going to go lower, either double bottom around 212, maybe a little higher, or go lower to the high 190s and then reverse aggressively. Top two ranges could be around 288 plus. Bottom range is 198, let's say. Worst case, 188, 178. So if I'm buying 198 or even 215, my stop will probably be 170 or so, something that's aggressively safe. And if that does happen, then really the whole trend breaks down. That would be a very interesting kind of double bottom there. It's almost like a head and shoulders pattern, but we shall have to see. Anything around there is free money, in my opinion. I could see this being worth 2 trillion, 3 trillion easily. If Apple and the likes are, this business is not as profitable, but in terms of its revenues and the growth that we're seeing, the growth is much higher. Profitability, net profits in 2020 were $17 billion. Net profits in 2021 are expected to be $27 billion. So I love this company and I want it in my portfolio, but I want it at the right price, so I'm not chasing it. Another one we covered a while back, Boohoo. These guys, they seem to be quite choppy. They held their ground above this point, the 311, which was really important. So they could just continue back higher. I would change my mind if they're above 350. I'd probably be buying. That's some form of attempt to regain this trend higher. And then we'd be targeting around 375, 380, another point, 395, and as high as a spike to the 430s. But if this fails, which I believe it has a chance of doing so, then these lower targets for Flash. A lot of people think that's crazy, but you know, I don't lose anything if it doesn't work. If it does work, there's an opportunity. Pets at home, what are we thinking? No true opinion on these guys. Pearson, typical cyclical, recovered, broke out further, and now is holding. You can see these were drawn back here, so we can see that one held, that one held. Really, it's bought at a premium if someone's bullish. That short squeeze kind of drama with GameStop and all that, the only one with a high net short interest of its size was Pearson. Then we saw that spike, so that was like a best case move to 908. 816 now, not too much upside and a fair amount of equal downside too. But the longer you hold, the more that trend consolidates. A little bit of a pennant forming, break, and then higher or lower, but normally it's higher. There are a lot of other stocks that I haven't included here. I should probably have a look through some ETFs. Yeah, let's have a look. I want to look at China specifically, but we have cybersecurity doing all right. Next gen connectivity, very similar. They're all quite similar. I've grouped them into tech relations. You can see the same move, the same 4 candles where you had a reversal, 3 or so candles down, 4 or 1 candle that tried to break down, failed, held, and then you had 4 candles of reversal back to the up. That is across literally anything. China ETF, very similar as well for Chinese internet companies. What do we see? I remember that move. 78 to 87. You make 10% in there. In fact, I don't remember seeing this one because otherwise I'd have been buying. How unfortunate. What's going on here? Nasdaq's internet ETF, very similar activity. Video game tech is basically this whole GameStop move because this equates for about 15% of this ETF right now, which is crazy. But it is what it is. Let's see. Video game tech. Fintech, similar. Fintech is literally mobile payments, any technology that takes on banking in a new sector of its own called Fintech. Dynamic software, yep. Computer software, software companies, that is promising. And that's some strong recovery. 146 to 164. That correction could just lead to new all-time highs with that form of reversal. We shall see. Microsectors, FANG. I can't seem to remember this one. Emerging markets, internet. Look at that. Oh, doesn't that hurt? Easy 10%. More than that, actually. Goodness me. Maybe 13 in 3 days. Generally, when I make an allocation like this, if I'm lucky in 3 to 6 months, on the right side of the rotation, I could probably make 13, 20%. Those are the kind of aggressive moves I like to go for. But in this case, I'd have gotten that target in a couple of days. I seem to have missed these. Shame. But the site does look beautiful, so I'm not complaining. And we're absolutely killing it with the content flow. Artificial intelligence. That. Robotics, artificial intelligence. So many things. This whole list I have is beautiful. Look at that. Semiconductors. Ooh. Clean tech. 3D printing. That took some hit. I remember that. I saw Proto Labs materialize just getting dumped as a couple of constituents within. 50 to 34. 16. Wow. That's 30% drawdown. Mad. 34 to 40. 20% move in a couple of days. That's disgustingly dangerous. Whew, what are we going to do? Innovative technology, social media, semiconductors, blockchain leaders. This blockchain leader one, Block, has a couple of interesting companies and cryptocurrencies breaking out as a recent. This seems to be one that stands out differently to any of the others. Autonomous technology, robotics, innovation of fintech companies, next gen internet, which, oh, these are the ARK ones, the Cathy Wood ETFs. They seem to have recovered quite well. Nice to see. For the sake of a lot of retail people who are holding in these guys. But yeah, so that's a look at a quick couple of charts, we seem to be streaming at a time when not normally many are around. But if you're watching this video, I hope it was of some sort of value. This is kind of how the market's looking. Are we going into value stocks? Are we going into growth? Well, personally, I like quality growth companies, but where is the trend now? We can't deny it's into value companies. Could last a year, could last 2 years, could last the next 10 years. But we act based off what is the facts. And the facts are that tech stocks are running out of steam, but it doesn't mean that they're going to zero in a way of tech stocks are going to crash, value stocks are going to, well, cyclicals are going to do well. It's more a thing of values going to likely outperform. So if you get quality tech companies on these pullbacks at good prices, it's likely that you're going to benefit. The positive of getting into those quality companies is they will be growing so much, and yet they'll have quality assets, profitability. They're not vulnerable to anything. So when that switch comes back, you'll see explosive growth amongst them. But they also will deliver growth. In terms of value companies or cyclicals, it's a bit riskier because a lot of them are systemically unimportant. Restaurants, for example, yes, they may hire a lot of people, but if one goes bust, another one can come up and take it. Low barriers to entry. Banking stocks, not so much. Financials, those companies, if those banks go to zero, they're bust, then the government needs to support them because so many jobs will be lost. Loans, dramas, all that were repeated 2008. And I'm sure governments across the globe don't want that to happen. So these banking stocks are generally safer, and with low yields, interest rates rather, it's odd to see. But I think the reason why they're making gains in their shares is because it's cheap to borrow money right now. And in doing so, they're increasing their loan books, but not specifically loan books to lend to people, rather loan books to get business activity going, managing money. It's a little bit of exposure, but their positives also include the fact that central banks across the globe are buying these bonds through quantitative easing. They're making asset purchases. They're buying weak bonds, creating liquidity. That liquidity is being used up to purchase into assets. Now, investment banks are buying up quality assets with the funds that are available. Their bonds are also things that can be bought up. And so, safer bonds, you'd think, they can pay their debts easier, likely. Safer shares. Shares get bought up. Investors are like, okay, well, I'm comfortable holding financials, which was never a trend for a very long time. If I pull up JP Morgan shares before we go, I will just show how poorly banking was viewed in the years post 2008. Yeah, well, as of recent, there's a recovery, but if you look at global stock markets, and JP Morgan's not the best example. Global financial firms, not stock markets, you can see that they weren't fared so well. You come out of 2008, yes, recovery, but then you have a fair amount of consolidation when the markets had huge rallies generally. Yep, fair amount of recovery, but nowhere near as much as you'd expect in growth stocks. So we shall see. I think personally, if value's going to take over, then value, which is quite broad, it's broad how you define it, then value will likely take over for maybe a year or two, and then that reversal comes back and an aggressive bull market for growth stocks. But we shall have to see. Nonetheless, I've been Ryan Kia of Quantium Research. What is that? Let's get rid of that. I don't even use Skype. I've been your host, Ryan Kia of quantiumresearch.co.uk and also Quantium Research Limited. If you've enjoyed this little bit of commentary about the markets, the state of markets right now, and with the value stocks will take over the performance of growth stocks that have been seen over the past decade, the impressive growth, we shall see. Those were my thoughts. They don't represent the thoughts of Quantium Research Limited or anybody involved, but they're simply my own thoughts. I could be wrong. I could be right. I'm positioning based off what I think. But anyways, I appreciate you for watching this video, and I hope you have a wonderful, wonderful day, week, month, year. Depends how long it will take for us to see each other again. I hope you have a wonderful life if we may not see each other again. All the best. I've been Ryan. Until next time.